Wealth management is more than just investing. Investing today should be risk-adjusted returns, and the art has now developed into a science that includes investing, tax planning, estate planning, and even philanthropy. We here at the Investing Edge try to educate all of you about the best wealth management practices. I'm Nigel D'Souza, and with me today is Feroze Azeez, Deputy CEO of AnandRathi Financial Services. All right, Feroze, first up, Budget 2020. Wanted to understand, how did you view it? On the day of the budget, everyone said it's going to be a big disappointment. And we know what happened to the stock markets post that. But how do you read it?
Nigel, I think it's very important to pragmatically look at the budget. My initial reaction, and so is it the same now, is that it was a very intelligent budget on a certain item, which was taxes. On taxes, it was one of the most intelligent budget I have seen in the 18 years I have been tracking this. On the economy side, I think there could have been more done in this budget.
Okay.
But why do I call it a very intelligent budget? And this is what was my first reaction. It was intelligent because India has so much complexity that there was no control on taxes the government could have had. There are 120 provisions which were there. So when the government tries to increase taxes for people, people would find another way around with the rest of them and bring down their tax liability. When it's trying to decrease taxes, it is not decreasing taxes. So when they introduced another absolutely clean method and also mentioned that they will phase out the current method of 120 provisions, I think it's a great step ahead. Mm-hmm. Then comes the next bit. Should we be all upset about it, or should we be happy about another method? See, India's average income is 1 lakh odd per annum. Per capita income is 1 lakh odd. In India, if you earn in a tier 2 city 15 lakh rupee per annum salary is a big salary. At that salary bracket, the tax for that individual in the clean method is 13%. For 10 lakhs, the tax is 8%. Mm-hmm. These are the least in the world. It can't get better than this. 10 times the per capita income, you pay 13% tax and 8% tax. So point one I'm making is it's an intelligent budget. Second, on the economy, they didn't do as much in the budget. But if I am an optimistic person, I would think that this government has never waited for a date to announce anything.
Sure.
They just out of turn announce things. So budget is a no event for them. If they have to do something for the economy, they will do it anyway.
Right.
So that's the key. If the economy continues to slip, I'm sure it's a very agile government to do something to bring the numbers back up. That's my take. And I think that's why the market realized that it was an intelligent budget, and that's how the country will progress, is why the markets came back to where they're back.
A valid point you're making. You know, we as Indians, we're always hopeful. We want everything. Budget 2020, if I went out there and asked for a wish list, we would have got a long list, a long list. We wanted something for the auto sector. We wanted something, to spur up rural economy as well. But you made your point. It's an intelligent budget. And in fact, this government has shown in the past, they don't need a budget to announce something. They'll do something when the need arises.
So that's a very, very good news for an HNI. So that's the first impact. And that's the most common impact. Second is, in every mutual fund scheme which we own, we are given a choice between choosing the growth option or the dividend option. The question now arises, who should choose what? So let me give you a thumb rule to make a choice, which is more prudent in terms of mathematics already done. If total income of yours is greater than 15 lakh rupees per annum, which is not very difficult to achieve for an HNI, you should choose a growth option on the debt side and also on the equity side. Okay. If your salaries are less than 15 lakhs, choose a dividend option on the debt side. On the equity side, if your total salaries are less than 7.5 lakhs per annum, you should choose a dividend option. So lower the salary, more attractive is the dividend option in the mutual fund. To most HNIs, dividend option is now redundant. So there is still 3-4 lakh crores of equity mutual fund money out of the 10 lakh crores there in dividend. And I'm sure a reasonable portion of that belongs to this community, or at least the homogeneous group of this community. So if it's so, if your advisor has still not advised you to move there, move it into growth so that you benefit that 0.5%, 1% in the long run. That's the actionable for a mutual fund investor, which I thought let me bring it to action rather than just the macro analysis.
Makes perfect sense, Feroze. That's a divergence. I'm sure all of you out there will be worried because India is growing at its lowest pace in the last many years. The GDP's number is only at around 5%. Isn't that worrying? But you look at the stock markets and we're off. We're off to the races, actually. There is divergence out there. Tell us, how do you read this? Stock market moving in one direction, while growth doesn't seem to be picking up, at least as of now.
Correct. So, economy doing bad, big stocks doing well, seems like a big dichotomy.
Yeah.
That is assuming that over the last 20 years, if you see, because now that we have 30 years of good, strong data of the markets, most of your answers will come from that data itself.
Yeah.
So we checked the relation between the market and the economic growth. So every year, if you write down how did the economy grow that year and how did the markets fare that year, there has never been a good relation between them. So this time it is more apparent because it is in the opposite direction, completely opposite direction. But most often than not, every year, there are years where you grew 9%, but the markets did minus 10% growth. So markets are not dependent on the economy completely. Markets are dependent on news. They're dependent on liquidity. And then they're dependent on how much are these companies earning, corporate earnings, and they're also dependent on economy. So these three variables cannot be ignored because they are overwhelmingly overpowering macroeconomic variables in the short run. In a 10-year time frame, there is a strong correlation between economy and markets.
Right.
So that's why news, liquidity. Now what happens is liquidity. Now look at liquidity. If you have to understand these four, if you want to understand something about the market, which is very difficult to any which way, anybody who tells you he knows the market, he's pretending to anyway, so I would not claim that. But these are the four things you can look at. Liquidity, news, companies' earnings, and economy. These are the four variables. Liquidity being very important in the short run. Liquidity comes from the Gora, right, the foreigner, and the domestic institutional investor, and the HNI and the retail. These are the three sources of liquidity. What is happening is the foreigners generally invest in large stocks. Mutual funds were also allowed to only invest in large stocks from April 2018. So mutual funds are also investing in large stocks. The foreigner is also investing in large stocks. HNIs have anyways burned some fingers, so they're not out. They're out of it. Retail is anyways participating through mutual funds. So what was happening is all the money was going to large companies and continues to go to large companies. That's why the top 10 companies of the country are doing phenomenally well. And the rest of the thousands of companies are not doing as well as the top 5, 6 companies of this country. So this whole phenomena of divergence of Nifty doing very well and economy is basically liquidity attribution than the economic attribution.
Well, Feroze, I wanted to ask you another query. In terms of returns, various people out here would be saying, I made 10%, I made 12%, I made 5%, I made 7%. How do you rate that I am doing better than other mutual funds or the mutual fund industry on the whole? Your answer to that.
Yes, because, so I'll take it in two parts. Part one is most people say I've made 15%, 12%, like you rightly said. That's an incomplete statement. We have to always, when it comes to mathematics or finance, there are two sides of the coin. How much return did I generate? How much risk did I take? You cannot, if you ask a child, how much did you score? If he told you 22 out of 25, that's very different than 22 out of 100, right? So whenever you say a return, risk is also mathematical. Now let me tell you. So when people ask, okay, you've been advising as a company for the last few years, how has been your client's return? So I would say the audited results of average returns of AnandRathi client for the last 5-6 years is 14.2%.
Okay.
At a risk of 6. At a risk of 6. Without that 6, this 14.2 is an incomplete, you can't comprehend whether it's good, bad or ugly. What is this 6? 6 is the risk of the return generated. Now because most of us might have heard it for the first time, because risk has always been English for us, high, medium, low. Now there's a numerical integer which I'm putting to risk, 6. It implies that you've generated 14. This 14 could have become 20, which is 14 plus 6, or 14 minus 6 also. So 14 plus 6 and 14 minus 6. That's the risk number. Now to give you a context to see it as a benchmark, Nifty risk, which is the largest index of this country, the risk of Nifty for the last 3 years is 13. Then now you know the benchmark of Nifty risk is 13, तो मेरा 6 13 से तो बेहतर है, आधे से कम है. Now I can conclude whether 14 is good, bad or not. So first, every one of us, I think we are duty bound to check what is my risk level. It is not a very complex thing. The name of this risk measure is called standard deviation. We should tell our advisors to check it for us. If we can't do it ourselves, you should tell your advisor, tell me what is my standard deviation. Is it greater than 13? Then you have to panic. Because यार निफ्टी से ज़्यादा रिस्क लेके मुझे 20% बनाना नहीं है. I have to bring risk control. So risk of Nifty is 13. What is your risk? That will help you understand how much risk you have taken. Standard deviation is a simple formula. You don't even need to know the formula. Microsoft Excel sheet हम सबके लैपटॉप पे है. उसमें formula already inbuilt है. उसमें बटन प्रेस करते हैं तो आपको बता देता है. How to calculate it? Either an AnandRathi representative, my colleagues can do it for you, or if you already have some other advisor who can do it for you, great. But it's a good start point to start measuring risk.
Feroze, you said you gave us a number that you'll have made around 14% the last 5 years. Or how do we validate these numbers? How do we know, the kind of returns?
Firstly, we should insist all our advisors measure it, right? So you should measure it. Now comes the question, so I get it audited by one of the big four, in fact, Deloitte.
Okay.
Every 6 months, Deloitte audits. If you would have just heard AnandRathi out, what would your return be? Because your valid question, मैं 14 बोलूंगा, लोगों को मानना पड़ेगा या नकारना पड़ेगा. Either you accept it or you leave it.
Sure.
So it would be an unfair thing to say this is 14.2% without an audit report. So Deloitte audits it every 6 months, saying that if you just would have followed it to the T, you would have made 14.2 at a risk level of 6.25 to be precise.
Okay.
That is significantly lower risk than most of our portfolios would be. Now, I'm sure everybody's table has a balance sheet on this. So if you put your assets, and I can tell you what the standard deviations are mentioned. So most of our portfolios will come with 11, 12 risk. So if I can bring the risk to half of the average HNI's risk which they're currently taking, and if the return can still be 13, 14%, then it is good.
Well, it's time to slip into a short break. When you come back, we'll continue with our Q&A session with our audience.